Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but he is on another due diligence assignment, so we wish Michael and his team at SPI a lot of luck closing another transaction. He's closing one down in Austin, in your neck of the woods, Hans.
Yeah, sure is.
Fantastic. So sitting in the podcast today is Hans Box, also with Old Capital. And we're going to start to have a conversation with Hans in a second, but I just want to make sure everybody understands we're coming up to the final days before the Old Capital Multifamily Conference at AT&T Stadium with some great speakers, some folks from Fannie Mae, some folks from the different banks that you want to develop a relationship, and definitely with the power players that are general partners, sponsors for multifamily properties. I want you to be able to have some great networking opportunities. Again, at AT&T Stadium, it is our premier event. We're looking at 500, 600, 700 people at this event, and we would love to see you. So if there's any way that you can get in a jet, come on down to Dallas and spend some time with us and do some networking. I think it's one of the probably premier events in Texas. So we appreciate you seeing you there. Go to oldcapitalpodcast.com to get your tickets. So in the podcast today, we have Hans Box. And Hans, as you know, is a loan officer for Old Capital. His area that he works at is in, say, southern Texas, between Austin all the way down to Houston. He is a very good loan officer. But one of the things that you may not know is that he's also a CPA, and he's also an investor too. So I thought we would spend some time with Hans and get to know him a little bit better, to understand what his background is. And this all generated from a conversation that Hans had done and shared with me, that he did a presentation to a bunch of investors at a kind of a meetup. Was it, Hans?
Exactly. It's an apartment meetup in Austin.
Apartment meetup, and Hans was on stage for probably about an hour and a half, hour and 20 minutes or so. Yeah,
it was it was over two meetups for about an hour and a half each time.
So some great information that came out of Hans, and the investors absolutely loved it. And it kind of bent my ear saying, hey, listen, can we talk a little bit about that conversation you had with a bunch of passive investors? As you know, a lot of these transactions are very large. When you buy an apartment building, typically it is not just you buying the property, it is done in a syndication. And within a syndication, we have limited partners. These are the investors that put their money into the transaction. So in the conversation that we're having with Hans today, I want to have you put on your investor hat. I want you to kind of understand what some of the terminology, some of the thinking, some of the theories behind investing in multifamily, some of the things you should be aware of, some of the challenges with multifamily, kind of understanding about how this whole thing gets put together. And so, again, we're an open book. We want you to understand a little bit about what's going on. And Hans is a perfect person. Again, he's a CPA, went to Texas A&M, got a CPA, and then he's an investor too. So I don't think you could have a better person to kind of explain what's going on. So Hans, again, welcome to the podcast. We appreciate that. And so tell us a little bit about your talk today.
Sure. Thanks, Paul, and I appreciate the introduction. Kind of set the stage. Where we're coming from here is from the perspective of a passive investor. Many times on this podcast, we talk about buying apartments and going on due diligence and doing the underwriting as a sponsor from the shoes of the sponsor, and buying the deal yourself or buying it in a syndication. But this particular podcast is coming from the perspective of the passive investor only, and how you would look at a deal. Multifamily specifically is what we're concentrating on here, but how you would look at a real estate syndicated deal, a real estate syndication, a private equity deal, and analyze that deal from top to bottom and decide whether to invest $25,000, $50,000, $100,000 in the deal.
So this is going to be a crash course in understanding about syndications and what to look for. Again, Hans is a CPA. He is not an attorney, and he's not giving legal advice. He is just being one of your friends trying to tell you this is what to look for and how to look at it.
Exactly. And honestly, I'll say this, and as a CPA, I know a lot of CPAs that don't know how to invest in deals. So it's more about experience, learned by trial by fire type thing. So
we'll talk a little bit about your background and what people should know a little bit about you. Again, you're a loan officer for Old Capital and you do commercial lending. What else do you do?
So as Paul mentioned, I'm a senior director here at Old Capital. And then I also have a private equity company with my business partner. It's called Box Wilson Equity. We've done 10 to 12 private equity deals over the last 5 to 6 years, spread across the multifamily, self-storage, and mobile home park space. And actually, we're working on distressed debt fund right now. I spent 5 years at a boutique Dallas multifamily firm, and where I evaluated and served as director of acquisitions on hundreds of deals. I evaluated hundreds of deals, and I've asset managed over my career over 3,700 multifamily units between that firm and our own personal deals. I've got equity investments in currently about 3,200 units of multifamily. I've been in as many as 4,300, and I've invested in over 2,000 units of self-storage. And I do a lot of other passive investing, which is why Paul pinged me to maybe chat about this a little bit. But like I said, I'm in distressed debt funds. I'm in hard money funds, industrial warehouse, land, convertible debt, and even a resort community, international resort community. So
unbelievable.
Yeah, well, some of them are good, some are bad, and that's part of what I'm going to be trying to teach here today is what the mistakes I made and the good choices I made. So basically, throughout the course of all this, helping other passive investors became important to me when I saw the pitfalls of some of my own decisions in the early years, where I should have done certain things that I didn't do, and so it kind of strikes a chord with me, and really has prodded me to be a little bit more outspoken to passive investors about what they should look out for in deals. And it's really opportune time because the Jobs Act passed in 2012, and because of that, crowdfunding has increased exponentially. Real estate syndications have increased exponentially. And then the real estate market itself has been on a hockey stick going up since 2011, 2012. And so a lot of times you've seen a lot of success in the real estate industry over the last 6 years. And new investors think they're doing well, but are they doing well because of the market? Or are they doing well because they invested well? And so that's what worries me a little bit, is that we may have people that have gotten overconfident in their ability to decide on what deals to get into, but then have had the market buoy them, and it really wasn't their decision making.
As I like to say, 99 attaboys does not equal to 1 oh shit.
Oh, yes. And to continue that basic statement, I would rather miss a good deal than lose a penny. I will pass up deals all day not to lose principal.
Great deal.
So we want to just dive right into some of the the subject matter.
Let's go.
And hopefully I won't be too dry, but at the same time, I'm trying to project just kind of the high level knobs, the high level things you should look at. And I think one of the first things that everyone should look at as a passive investor is some important terms. You've got to understand some basic important terms to be able to evaluate a deal and understand what's being said in a business plan. One of those is the cap rate. And most people listening to this podcast probably understand the capitalization rate. But that's basically your net operating income divided by your purchase price. Mm-hmm. It would be the return you would get on the deal if you had no leverage, had no debt on the deal, and just paid it's for it. It's as simple as that. And it's really important because that's how real estate's valued. Some other terms to think about are ROI, IRR, and equity multiple. And I'll step through these really quickly, but those are things you should research and try to understand how they're calculated so you have an idea of what they mean when you see those numbers on somebody's business plan. Mm-hmm. ROI is return on investment. Basically your average return per year based on the distributions you receive, starting with year 0 when you make your investment, ending with the last year when you get all your investment back, hopefully, and a capital gain, hopefully. IRR is similar to ROI, except that it takes into account the time value of money. That is really the difference. It's actually can be quite complicated if I try to explain it verbally here, but it basically takes into account the time value of money and when you receive those distributions. ROI just takes an average. And then the last one to understand is equity multiple. An equity multiple is simply the total amount of money you received over the course of the investment, including the return of capital, divided by your original investment. So a 1.5 equity multiple on a $100,000 investment means you got $150,000 back at the end of the investment when you add up all distributions to you. And that's important because you can have a really high IRR and a really low equity multiple if the deal is really short. So if you have a 6-month deal or a 1-year deal and somebody flipped an apartment deal, they can then tout a really high internal rate of return, but at the same time, their equity multiple wasn't very good. So your money didn't earn you much for a very short period of time. Then you just have to invest it again. So those are things you need to research. I'm just touching on the tip of the iceberg here, but you need to research those terms and understand them to be able to evaluate deals.
How about a cash on cash?
Cash on cash is basically, it's similar to ROI. Cash on cash would be your annual distributions received on the operations of the property. So basically what you received on your, a cash on cash for $100,000, an 8% cash on cash is $8,000 a year on a $100,000 investment.
So some transactions are value added, some transactions have a yield on it, and sometimes in the value added, you may not get a return of your cash on cash immediately. You may have to wait till the time the property's fixed, stabilized, and maybe sold to get your cash.
Exactly. And you have to go into deals with your eyes wide open and understand that on a value add, you may have a bigger capital gain on the back end, but your first couple of years or first multiple years may have lower cash on cash because there's things you have to fix first.
Right. Let's go into some of the definitions of important terms.
Well, some other terms to know are what a pro forma or projections are. That's simply what the sponsor is basically projecting on their profit and loss statement, what they're going to do with the property. In other words, where they're going to take it from where the current operations are, the current P&L, and how they're going to improve the expenses by decreasing them, hopefully, or improve the income, or do both. You'll hear the term sources and uses thrown out a lot. And I think that's important. A lot of people miss that. And that's something you should always ask to see if it's not provided to you in a business plan or in a private placement memorandum or what have you. And that will tell you kind of where all the sources are for the cash. In other words, how are they coming up with the money to buy the deal? How much debt? How much equity? And are there different classes of equity? Things like that. And then the uses are basically the purchase price of the property, upfront rehab, fees, closing fees, attorney fees, and then most importantly are hopefully they will show the fees that they're charging as a sponsor in their sources and uses so you can basically drill down and understand what they're getting paid as fees as well. And that's a good place to always look. I always look there first to get an understanding of the kind of fees that a sponsor may be charging. Mm-hmm. The last one is carried interest. You hear that term, you hear waterfall, you hear compensation model. Those are all related to basically how the deal is structured between the sponsor and the passives. So basically, you hear the term say an 80-20 split. So the investors get 80% of every dollar distributed of profit, and the sponsor would get 20. That's a very simple thing, and I'll go in that a little bit detail here in a second. But those are the terms you need to understand what those are. It's basically just how everyone gets paid. And then there's a preferred return and a hurdle rate, which are kind of components of that, where a preferred return is investors get an X amount of return or cash on cash, as Paul mentioned, first, before the sponsor may participate. Some people like that, some people don't. And then a hurdle rate is getting a little bit more complicated, but it's basically has to do with internal rate of return and the sponsor giving you all your money back in a certain IRR before they get a bigger split of the proceeds or the profit on the deal. So
on something like that, preferred rates of return, I look at some of these transactions where the cash on cash is only 5%, 5.5%, but the preferred rate of return is 7 or 8 or 9%. What do you think about that?
Well, actually, I am a proponent of a preferred return. Some people I know aren't, and I know the reasons they aren't. I think that if you're going into a deal projecting a 5 to 6% return, and you have a pref, what they call a pref or a preferred return of 8% or 9%, the sponsor knows up front that this preferred return is going to be accrued for a number of years until they can hit that hurdle. And so they know that up front, and there shouldn't be an issue with that. I like the preferred return on a personal level because I'm okay with sponsors getting some reasonable fees like everyone does in real estate. But in terms of sharing in the bigger portions of the deal and to take chunks of the cash flow and especially the gain on sale, they need to hit a minimum return, in my opinion, before they should participate. So I want them to have incentive to get to that 8% or 9% before they start really participating in the deal itself, so they have more incentive. That's my opinion.
Okay. So how do you evaluate sponsors?
So evaluating sponsors, that's a large question, but there's a few high-level things you should always look for in a sponsor. Number one, a sponsor matters to me even more than a deal. You are betting on the jockey. And I've seen sponsors that are really good sponsors turn a so-so deal into a home run, and I've seen sponsors that turn a home run deal into a dud. It's just sponsors are really a huge piece of this. It's kind of where I made my mistake in some early deals that I did. Not that it was a huge mistake, but I should have done a better job evaluating, and it was a learning curve. I didn't lose any money, but I didn't make much. So it was kind of a waste of my money for a few years. You really got to get to know the sponsor by either through emails, through calls, and even better, if you can meet them in person. And I know that's not always possible with a lot of deals being national and there's crowdfunding. Mm-hmm. But if you can meet the person and meet the man or woman and shake their hand and get to know them on a personal level, just high level, it means a lot. And a lot of people have good sixth sense. And once you meet someone, you kind of know whether they're who they say they are. Track record. You want to look at their track record. Their history in the asset class you're investing in. If we're talking about multifamily, how many multifamily deals have they done? What have they done in multifamily? Can they provide you what their returns have been historically on deals that they've sponsored? I do want to stress, though, that a track record isn't necessarily a deal killer one way or another, at least not with me, because I know in fact, I've got a couple of borrowers right now that are newbies, and I would invest with them and feel that my money is completely safe before I would invest with some really experienced sponsors that I know, just because I know them personally and I know that they would basically, give their lives not to lose a dime of investor money. And so my point is that track record is important. It's a good data point to look at, but it's not something that should make or break a deal. You really need to judge the person behind it. And then one of the most important things to me is transparency, their motivation, and their alignment with you. Can they clearly articulate and support the value proposition of the deal? What's very important to me when I'm looking at a deal to invest in real estate is that there is a value add component. And we hear that thrown out, every day by the real estate brokers, of course. But what I mean is true value add. Can that sponsor articulate what the true value add is in a deal? Because especially right now, because the market is so hot, that all the deals and the cap rates are very compressed. The deals are really expensive. And if there's not a value add component to the deal, you don't have any margin of safety.
So I thought I had read when I was in college that if you went down a retail strip center and you had a bunch of signs in the window that said sale, 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 that you would be more likely to have people coming in when the word sale was there. So it's kind of a trigger word. And the same thing in the multifamily business. The trigger word is value added.
Yes.
So there's value added properties, and then there is value added properties, meaning that there's no value added that's going to happen to the property. So sometimes when you say value added, it is a trigger word, but it really means nothing behind it. So I think, Hans, you're absolutely correct, is that you got to really kind of figure out, is this something that is a value-added property?
Yeah. Is it truly value-add, or is it just a buzzword being thrown out
there?
Right. And so you want the sponsor to be able to clearly articulate that and explain it to you. What is the value add in the deal itself? And that should be really easy for a sponsor. Mm-hmm. Transparency. This is a big, big, big thing with me. If the sponsor doesn't willingly and consistently answer any and all questions about the deal itself to you, and their team, their track record, then, that's a red flag to me. Mm-hmm. They should be able to send you reporting examples. In other words, what they've done in prior deals, how they should send you their current deal P&Ls if you ask. They can mask or sanitize the document, but they should at least be able to send you the P&Ls and other documents on their current deals. Are they willing to share how they typically calculate distributions and reserve for contingencies, things like that? So my overall point is that you should be able to ask any and all questions, viable questions about a deal, and the sponsor should be happy to provide you the documents and provide transparency. And I have had quite a few experiences within the last year even where I get sent a deal, I ask a few high-level, simple questions that any sponsor should be able to answer, and I don't get a reply. And then I notice that I never get another email from that sponsor. Well, that means I got dropped from the email list because I was one of those investors that decided to dig in and just ask a few simple questions. And believe me, these were simple questions. These weren't questions that were tough, and they were standard questions that anyone should be able to ask. And I'm happy that they didn't reply or took me off their email list, because if they can't reply to a simple set of questions on a simple deal, then it's not somebody I want to invest with, because they're not transparent. And I think that's happening a little bit nowadays because it's easy money right now. There is a ton of equity in the market, And because of that, it's easy to raise money. And in my opinion, that's not how you should treat a potential passive investor. And it kind of just tells me that, well, if you won't respond to my questions now and the deal is going fine, what happens if, something hits the fan in 3 years and we go into a recession and I start asking questions, then I may never hear from you again. That's what goes across my mind.
Do you want to see the sponsor's personal financial statement, their credit report, and criminal background checks? What are you looking for in them personally?
If I don't know them at all, I would probably want to see at least criminal. I've never asked for a credit report. I just want to see history on what they've done before, a bio, and talk to them. But I don't have a problem at all if somebody did want to. At me as a sponsor, I've sponsored quite a few deals, and I continue to right now. If somebody asked me for any of those things, I'd give it to them in a heartbeat. It doesn't matter to me because I want to meet passive investors, and I'm going to practice what I preach. If you ask me legitimate questions, I'm happy to answer them.
And how about, are you looking for the sponsor to put skin in the game?
Yes, significant skin in the game.
What's significant? What does that mean? I
would say, the sponsor group themselves should put at least 10 to 15% of the equity in a deal. It'd be high level, but to give you guys a better idea, basically myself and my business partner, no matter what fund we're doing, we'll each put at least 50 and typically more likely 100 to 150 in each deal or each fund that we do. And if a sponsor is not going to do that and won't put skin in the game or is putting very minor skin in the game or money in the game and it's only $25,000, et cetera, then I would suggest that you ask them why and possibly back out of the deal if they can't put enough skin in the game.
So are you also looking for people that are motivated in this transaction? Are they hungry to take your hard-earned money? Are they motivated?
Yeah, that kind of sums up what I've been saying here on these prior statements is, yes, I am looking for somebody that's motivated and hungry. And just because, and that was kind of my point, was that even with a new investor, I do know typically know that they're motivated and hungry. This is their first deal. They want to do well and they will answer all my questions. And I can tell if somebody's complacent or not as hungry on a deal when they don't answer questions or they seem annoyed that I'm asking questions or I get one-word answers on an email, things like that.
Right.
It's pretty easy to tell. So yes, motivation and hunger are very important. And you don't necessarily want to be with a sponsor that's on their 10th deal and it's June for the year.
And that does happen out there.
It does. And that's why you have to be careful.
They pick up a lot of these syndication fees or sponsorship fees. There's a lot of fees that they tie into the transaction that you have to be aware of.
Exactly.
So let's talk about evaluating the pro forma. Tell us a little bit about that.
Sure. And I mentioned this briefly in the beginning there, but sources and uses, that's one of the first things I look at. And that kind of gives you an idea of the capital stack and how the capital is being acquired for the property, and then how you are using that capital on the property itself, the purchase price, the sponsor fees, legal fees, lender fees, things like that. The next thing you need to be able to do is you need to look at their pro forma profit and loss statement. And this is a must. I mean, basically, if you're going to invest in private real estate and you want to actually evaluate the deal, you must be able to understand how to read a P&L statement or a profit and loss statement. You don't have to be a CPA. You just need to be able to understand how to read a P&L and understand what you're looking at. You want to be able to see a pro forma that shows true cash flow so you can tie it out to their projected distributions. Many times I see these pro formas where they stop at NOI and then they tell me I have a 10% cash on cash return. But there's no way I can tie that NOI to what my return is going to be because there's other things below net operating income, NOI, that come into play. The debt service, is there principal and interest? Or is it interest only debt? CapEx spend, things like that, other asset management fees. You want a very detailed P&L all the way down to cash distributions.
How about the P&Ls that push out that rents are always going to go up and go up by 5% or 6%?
Exactly.
Or 7% every year.
Exactly. When you see everywhere here in Dallas, for instance, that the projection's about 2% or 1.9%, I think I saw the other day. So yeah, that's huge. You want to understand, that's one of the things I'm talking about is where you're looking at the income, the P&L statement, and you're seeing the income go up by, as Paul mentioned, 5-6% a year. And then they need to have support of why they think it can go up 5 or 6% over perpetuity, which it can't. There's always that value add component possibly in the beginning where you bring rents up to market or you do upgrades and you bring the rents up to market. But it shouldn't just be 5 to 6, 7% rent increases every year. You can put that into any pro forma and hit a home run. So
sure.
cap rate, you want to understand what a cap rate is and understand what a going in cap rate is, meaning, in other words, what are you acquiring the property at? And then what are they assuming for their exit cap rate? In other words, what on sale, what cap rate are they using to value their property? And that's very important. That's probably one of the first things I look for is I try to get an idea of are they basically increasing the cap rate for sale in year 5 or 7 or 10 or whatever they're projecting to sell the property. Are they increasing the cap rate? Because if they're not increasing the cap rate, they're saying that basically that properties are going to be valued in the same way in 5 to 7 years as they are now. And basically there needs to be a good reason for that. We are probably in the lowest or most compressed cap rate market, at least in the DFW area, that I've ever seen. And it's probably in the last 30 years or maybe forever. Paul, you have more experience. You probably have seen this, haven't seen anything like this.
Pretty low.
Yeah, it's about as low as it gets. The interest rates aren't quite where they've been, but they're still pretty darn low. And so really there's only one way to go, and that's up on cap rates. And because of that, at least in today's market environment, I want to see at least a 100 bip increase in cap rate on your exit, just to be a little bit conservative. Just because you're buying at a 5.5 or 5% cap right now doesn't mean in 5 years when interest rates have gone up and maybe the market has cooled off, or maybe we're in a small little recession or dip in the economy, that we can just sell it at the same exact cap rate, especially it's 5 years older. Now, there are times when you can justify we're in like you buy in a gentrifying area that you know in 5 to 7 years is going to be completely built up, but that's rare. Most of the deals, that we're buying and we're seeing and we're lending on are suburban deals and deals in working class neighborhoods. So anyway, cap rate's really important. That's something you should always look at. Property tax assumptions, should always look at that. In Texas, property tax is very, very aggressive. And because of that, you can get into real trouble on deals if you don't conservatively estimate on property tax valuations. Here in the Dallas area and also down in Austin where I am, and San Antonio, which is Bexar County, Travis County in Austin, and Tarrant and Dallas County here, they're pretty aggressive on valuations, and they see a deed change hands, they'll aggressively go out and value a property at a high value in order for you to bring in to force you to bring in your settlement statement and prove it's not quite that high and you bought it for X. So basically the point is that you can't just assume property tax is going to just go up 3% a year after you've bought it. You've got to have a conservative estimate going in, and that's one of the first things you should look for as a passive investor on the profit and loss statement. Look at the rent and expense assumptions. Are they reasonable? We spoke about that earlier on the rent side. You want to compare to the historical T12. Does anything seem off, or are they reducing expenses a massive amount or increasing income a massive amount? If they are, there may be a good reason, and just ask the question why. And then I mentioned this earlier, most important thing, again, from the sponsor, I believe, is can they clearly identify the value add component in the deal? Where are they going to force value to protect your investment, basically, going forward, if those cap rates increase? Another important item that Paul and I are really close to is the financing piece. You want to understand what kind of loan they're getting and why they're choosing the certain kind of loan that they may be. In other words, the term of the loan. Is it floating? Is it fixed? Is there a reason that the term may be short, or is there a reason that they may have chose a floating rate note? I mean, typically, and Paul, correct me if I'm wrong, but we typically, as investors, would much prefer to see a long-term loan fixed rate because that's safer. There are reasons, however, to get a shorter-term loan or a loan with a lower prepay or a floating rate if you can't get a long-term fixed-rate loan to make the deal work. If you got to buy in a deal that has 60% occupancy and has a bunch of rehab needed, you're not going to be able to get a long-term fixed-rate loan. You need to get some sort of a shorter-term loan with a floating rate or like a bridge loan in order to fix the property up, put it back together, and then go get a fixed loan later. But so you got to understand the financing behind the deal and why they're choosing a certain type of financing. On the exit plan, is there a prepayment penalty? Are they assuming they exit in 5 years, but we have a large prepayment penalty? And if it's going to be assumed at that time, then that's great and all. There may not be a prepayment penalty, but a new buyer that's going to be assuming a note may have to put down a lot of equity. So you have to understand what is their exit plan and why do they think they can exit in 5 years with a note that has a large prepayment penalty. Again, it can be explained. It's a good question to ask if you don't understand the underwriting when you read it.
Financing is such an important point of investing and understanding the reason why some people use this type of loan versus another type of loan. Why does somebody do a Fannie Mae loan versus a bridge loan or a bank balance sheet loan? So you've got to understand what the exit strategy is and pick the right loan program at the beginning. So just like what Hans was saying, is that if you do come to your fifth year, it's better to have a low or no prepayment penalty versus if it's a $10 million deal and it's $1 million or $2 million prepayment penalty. That doesn't seem to work. And then if you have somebody assume the loan, what kind of leverage is that person going to get on the assumption? Is it going to be 80%? Is it going to be 75? Is it going to be 70? Because people are very prudent on where they want to put their money, or investors want to put their money. So if they're asking for a lot more money to be put down with lower leverage, they may not choose your transaction. Another thing that I wanted just to talk a little bit about is on bridge lending. There are some areas in, say, the state of Texas is that Fannie Mae does not like. They think they may have just too much exposure to one marketplace. One of the marketplaces, say, let's use an example, is Tyler, Texas. Tyler is a great area. It has a big economy based on oil and gas, but Fannie Mae has just too much lending in there that Fannie Mae has done. So they don't want to put any more loans typically into that marketplace. They don't want to put brand new loans. Now, if you have a Fannie Mae loan, or the seller has a Fannie Mae loan on that property and that they're selling it, and if somebody can assume that loan, that's good. Fannie Mae will accept that. Or if you want to use Fannie Mae as the ability to do it, they'll accept that. But what they don't want to do is that if you have a bank loan on that property, or the seller has a bank loan on the property, Fannie Mae does not want to put another loan out there. And that's for sponsors that haven't done a lot of business. Maybe for sponsors that have done, buyers that have done, 10 or 15, they may make an exception, but typically they will not. So that's something I want to kind of talk a little bit about, is you want to make sure that there may be a reason why your sponsor has decided to do a bank loan or has decided to do a bridge loan or a balance sheet loan instead of a Fannie Mae loan. And it may be because Fannie Mae doesn't want to lend in there. And the second point is that if Fannie Mae doesn't want to lend in there now, what happens in 2 or 3 years when you've executed your plan? Will Fannie Mae take a look at that deal at that period of time? And what happens if they don't? That means the next buyer who's buying your property is going to be faced with the same issue or situation, is that new buyer maybe have troubles getting financing. So that's just something to be aware of why the sponsor has chosen this type of financing, and does it make sense for you to invest in a deal that at the end may not be able to be sold for the next buyer to put agency financing on it. So that's something just to consider. And what else do we need to know about that?
Well, one of the last things I'd look at on a pro forma is the sensitivity analysis. Basically, does a sponsor provide you kind of with a analysis of what is the downside risk on the deal, and honestly, what's the upside on it? So in other words, there's major knobs that can be adjusted on when you underwrite or you pro forma a deal, things like what I spoke about earlier, your cap rate, your property tax, your rent increases, your occupancy, things like that. And so do they present a sensitivity analysis and say, okay, here's kind of the range where we think this deal will come out in terms of returns, and what is our downside on the deal? Realistic, not the apocalyptic, everything's over kind of deal, but basically if rents don't go up where we think they are, if occupancy drops, we have a recession, or if cap rates expand a lot, where might we end up? Maybe we're instead of at a 14 or 15 IRR, we're only at an 8 or 9. Well, you know what? That's not so bad. I mean, that downside risk of 8 or 9 on a deal with reasonable assumptions isn't necessarily a bad thing at all.
So let's talk about compensation, fees, and how much some of these sponsorship groups can make and what you should be knowledgeable about.
Sure, Paul. And so I'm going to kind of step through some of the high-level fees and what I have personally seen and kind of the ranges that we may charge with our company on these certain fees, and then make some comments. And there is no necessarily right or wrong. It's part of it is decision-making on your part to decide if you think they're reasonable for the work they're doing. But these are basically what I've seen in the probably close to thousands of deals now that I've at least looked at. Acquisition fee, it's typically between 1% and 2% of the deal size, of the purchase price of the property. The bigger the deal, the lower the percentage. And honestly, in some of my opinion is if the deal is, huge, $40, $50, $60 million deal, it should be capped. That's of my opinion. I don't like massive acquisition fees where the sponsor's making $500,000 on a deal, and it really takes just as much work to close a $10 million deal as it does a $30 or $40 million deal. So they shouldn't necessarily get paid 5 times as much or 4 times as much.
Sure.
loan signing fee or debt placement fee. Typically, that's about 1%. And in my opinion on those, as an investor coming from a passive investor side, a 1% is fine if you're signing on a recourse note. However, in my opinion, if you're just signing a non-recourse Fannie or Freddie loan, I don't really like the sponsor to get a debt fee on that because they're not really taking much risk, to be quite honest. Some sponsors charge a disposition fee, like a 1% disposition fee. That's quite common. Asset management fees are typically 1% to 2%. Those are on top, of course, of the normal management fee. The asset management fee goes to the sponsor, not the management company, and that's for basically steering the ship and managing the deal on a daily and yearly basis. And there's a lot of work to be done, so that's a deserved fee.
So that's not a management fee to manage the property. This is to kind of oversee the management company. Okay.
Correct. Yeah. So a management fee might be 3%, and then the asset management fee might be 2%. So you might have an overall management fee of 5%.
I gotcha.
There's sometimes setup and organizational fees to cover basically, legal and things like that up front on a private placement memorandum, things like that. And then construction management fees, typically what I've seen is they range from 5 to 10% of the rehab budget. So I think anywhere in that range is pretty standard. So that's kind of a high-level overview of fees. And then what I wanted to step into real quick are compensation models or waterfall structures that I touched on earlier. They are always defined in detail in your PPM and more importantly in your company agreement, which is the agreement typically in LLC, which is called an operating agreement or a company agreement, where they define what the structure will be on the distributions. There are a million different ways to do compensation models.
It's a white sheet of paper, and you can kind of create anything you want to have. So give me some examples.
Sure, and I'm just gonna give you 2 examples because there's 1,000 of them, and these are kind of the ones that you see the most often. Is what I'm going to try to touch on here. There's one called what you probably hear the term straight splits. That's what I spoke of earlier, where it's a 90-10 split to investors, or 80-20, or 70-30. Very simple and understand. And basically, for every dollar that's a profit that's distributed, whether that's operating profit or gain on sale, if it's an 80-20 split, 80% of that dollar goes to the investor and 20% of that dollar goes to the sponsor. Typically in deals like this, if the deal does really well, meets projections, the investors do really well. Mm-hmm. A straight split is always best, typically, when you have a deal that does well. However, the sponsor will make money even if the deal doesn't do very well. So that's kind of the difference, and the reason that I'm not a huge fan of straight splits is you could be promised a 15 IRR, and then you could only end up getting a 9% return, and then sponsor still got on an 80-20 split 20% of the profits. Mm-hmm. And that's the reason I personally like to go for a different type of model with a preferred return. But straight splits are really common, and a lot of sponsors like it because it's simple for investors to understand. Another very common model that I see are called waterfalls, and this is how we do it at Box Wilson Equity. It's changes by the deal because it really depends on the risk of the deal, but typically it's some sort of preferred return. Ours is typically around 8%, depending on the deal. So you basically means you as an investor would get an 8% cash-on-cash return on your money invested before we share in any of the profits generated by the deal itself. And then there may be a split above that 8%. So once you get your 8, then every dollar after that 8% is split, say, 70-30, 70 to the investor, 30 to the sponsor. And then basically up to a 12.5 IRR. So in other words, you get your 8%, and then every dollar up to a 12.5% internal rate of return is basically split 70-30. Now, an IRR or a 12.5 IRR can't really be achieved until you sell the property. The only way you can really achieve an IRR is get your capital back. So basically what that means is you got 8%, then you got 70 cents of every dollar after that 8% up until I sold the deal. And then after we sell the deal and you hit a certain internal rate of return on your money, in other words, in our case, we typically use 12.5%, then there is a more generous split to the sponsor after that 12.5. Ours has been anywhere from about 50-50 to about 60-40, 60 to the investor, 40 to the sponsor, or a 50-50. Above a 12.5. So that means you already made 12.5% return on every dollar invested and you got all your money back. That's when we really share in the upside. And so the way our deals are structured and the way the deals that I like to invest in are structured are that the investors themselves get a basic good return before the sponsors can really share in the upside. In other words, the better I do on this deal, the way more money I make. So I'm incentivized to hit a home run every time. And that's really where I can make my money, is to get you like a 17% IRR. That's where I can make a lot more money.
Now, so you're participating in the cash flow of the property too?
I am, after an 8% return is given to the investors, but I'm not participating in that first 8%. I'm only participating in the amounts above an 8% return.
Gotcha.
There are a million other structures. There are even structures where they have that, and then there's a catch-up to the general partner afterwards, and they can get really complicated. And this is probably something that if you guys are really bored on a Saturday night, can go Google waterfall structures and learn about them all night long.
Company agreements. What else do we need to know about our company agreements?
Yeah, so I'm going to jump a little bit away from the numbers and into more of the legal side of this. And again, I'm not an attorney, and so this is just my opinion and what I look for. And I've read a lot of operating agreements and kind of learned my lesson in a few cases. And these are the high-level things I look for. One of the big things I want to look for is replacement of the managers, which is basically the sponsors. Can I replace them for cause? Can I replace them without cause? Or can I only replace them if there's fraud involved? In my opinion, I like it when basically sponsors can be replaced for any reason by a majority or required interest vote of the investors in the deal. It shouldn't be only because there's fraud. And if the guy or the girl isn't doing a good job on managing the deal, I should be able to replace him or her as a passive investor and get somebody in there that will save my money.
What's the number, though, like on our vote? Is it 51% or is it 66 or 66.6 or 7? Because sometimes these ownership groups have voting rights themselves, and sometimes, since they own so much of their own voting stock in the deal, they can never be voted out. So
exactly.
How do you deal with that?
Well, you got to look at whether or not, okay, so if they can be removed, does the vote have to be unanimous? Mm-hmm. Does the vote have to be required interest, which is typically 66 2/3? Or is it just majority, 50.1%? Mm-hmm. Then you have to look at, well, what part of that voting, or overall of the 100% of voting, what part of that is managers or their affiliates that have that voting? So what you have to be careful of is that they say, yeah, well, it requires a 75% vote, but they have 30% of the voting. Well, they can never be removed. It doesn't matter if they can be removed. They will never be removed. Right.
I've seen deals that way that I didn't like at all, just because if the manager in the future does a pretty poor job, you could never replace them. And it didn't make a difference if it was fraud. If they were just bad, it would be very difficult to get them replaced. So make sure that on your operating agreement or the company agreements that you have a discussion with your PPM attorney and making sure that's in the operating agreement.
Exactly. The point is to plan ahead here. You're not planning to fail, but you want to. This is a business, and you want to make sure that if something goes wrong, that you have some recourse.
Yep.
If a manager or a sponsor is removed for whatever reason, do they get to keep their carried interest, which we just spoke about? Do they get to keep their sponsor interest? Of course, if they invested money, they should get to keep that. But do they also get to keep their override or their 20% or their 30% in the deal? My opinion, in our agreements, our investors can say, no, you can't keep that, or they can vote for us to keep it. But my bet is if we got removed for not performing, then we basically won't get to keep our sponsor interest because our passives won't vote for that. Mm-hmm. And can members vote on replacement of managers that were removed or resigned? So some managers may be removed, one of them may be removed, or maybe one or both of or multiple managers may resign for various life reasons. You want to make sure as a passive that you as a partnership get to decide who's going to replace them. That's key, because you don't want them to basically assign it to somebody else and have the power to put somebody else in their place without you having a say in it.
Absolutely.
Basically, you want to understand the complete legal structure. Are there other offerings or other classes of shares that are participating in the equity along with you? Are you junior equity, below a preferred equity tranche? You just want to make sure that you understand where you are in the capital stack and when you get paid, basically. One of the big things I have seen is distribution language that we kind of just spoke of, but it's key if to dive into it in the company agreement to understand it is you want to understand how distributions work for cash from operations and cash from capital events. At sale or refi, do you get your capital back first before the sponsor shares in the split? That is a huge question, and I amazingly have seen this in quite a few company agreements where basically the sponsor gets 20% or 30% of every dollar distributed after you buy the property, And it doesn't matter whether it was your capital or profit. They just get every dollar. So basically, if the deal doesn't do well and the deal is short on capital, they will literally end up taking some of your capital at the end if the deal doesn't do well. And that's language that you have to look out for.
Okay.
So basically, to kind of sum that up, the whole point here is that I trust my sponsors, and I wouldn't invest in them if I didn't. But trust doesn't really govern what happens if the deal goes sideways. You've got to have some basic protections in your company agreement.
So we need to start thinking about closing this thing out. So I could sit here and talk about this for hours because there's so many different ways of splitting profits, but you make these agreements not during the good times. You make these agreements to make sure that you are protected if things go south. And since I've done this for 35 years, there's been a couple partnerships that I've seen go south. So everybody refers to, well, what does the operating agreement say? What does the operating agreement say? So make sure that when you form these operating agreements that you understand what's in there just to help you. What are some closing words?
Sure. Thanks, Paul. So basically this presentation was pretty short, but it's kind of about mitigating risk. And some of the things I said might have sounded scary or things you want to avoid, but passive investing can allow you to create financial freedom without necessarily quitting your main occupation, because you may love that main occupation. Multiple cash flow streams are the key of how you generate financial freedom. But to become financially independent, you have to learn to depend on only one person, and that's yourself. And to do that, you have to first invest in yourself, which is learn how to look at a passive investment opportunity and be able to do the high-level things to protect your investment. One of the things I like to tell a lot of people that express disinterest or don't want to learn or don't want to analyze a deal is to say, a lot of people will spend weeks and months trying to save money or buy the cheapest TV or the best car or the perfect brand of appliance, but then they make a $50 to $100K investment in a passive investment deal without doing almost any due diligence whatsoever and not spending any time. And it's just amazing to me that you would do that. If you really want to create financial freedom, you have to treat this passive investing as a second job.
There's no doubt about that. I mean, when you buy stock in Wells Fargo or in Microsoft or in Google, there's agreements that go along with that when they issued the stock. And you are never going to talk with the CEO of Google or Apple. Here, you're talking when you're putting these operating agreements together. You're talking to the attorneys. You're talking with the sponsorship group. You're trying to form these deals. And they're using some of your information as input into the operating agreement. So be vocal when these deals are being put together. Exactly.
And I'll go back to my overarching point here is mitigate your risk. Never hesitate to ask questions. And think about this example. If you have $100,000 and you, for some reason on the deal, lose 50% of that capital on a deal, you only have $50,000 left. You have to make 100% return on your remaining money to get that money back. So that's why I said in the beginning, I don't like the lose principle. Mm-hmm. And discipline, consistent, and persistent actions are more of a determining factor in the creation of success than any other combination of things, in my opinion. And that's what I mean by about being disciplined and doing your due diligence on a $100K investment.
Wow, some great information. Hans, if somebody wanted to get a hold of you and just kind of talk through it and understand a little bit more, again, you're a loan officer for Old Capital. Tell me a little bit about other things that you can do to talk with some investors.
Sure. I can be reached by either of my emails. My Old Capital email address is HB as in boy, O as in Oscar, X as in X-ray at oldcapitallending.com. And my private equity email is hbox at boxwilson.com. And I can be reached at either one of those emails. I get all of it in one place. And I also can be reached at 214-641-6309. And I'm happy to speak with anyone about passive investing. I'm actually on kind of a side gig I'm working on. I'm working on actually taking the high-level points that I've enunciated here and turning that into more of a comprehensive, robust, deep dive training into how to look at deals and kind of a summary for a passive investor to use to look at deals.
That's great. So some great information from Hans Box. Do appreciate you coming up and telling us a little bit about it and spend some time with Hans to kind of understand a little bit more about passive investing. So again, thanks, Hans. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.